Welcome to the best investment writing, your gateway to the minds of the world's most respected investors. Join us as they unveil the insights gleaned from their tireless research, providing you with invaluable perspectives to enhance your own investment journey.
All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Hi, this is Anton Wintner. I'm a senior clinical research advisor at Verdad Advisors. We're a $1.5 billion systematic hedge fund based in Boston, Massachusetts. If you find this article or other work interesting, please go to our website, verdadcap.com, to subscribe to our weekly research. Now, let's get into this episode. I'm going to read our white paper entitled Biotech Investing: Investment Approaches That Work in a Challenging Industry by Greg Obenshain, Daniel Rasmussen, and Anton Wintner, MD. Introduction. Coordinates. Pharmacyclics was on the verge of failure. The company had IPO'd as a biotech darling in the late 1990s, peaking at $12 per share. In a pivotal Phase 3 trial, the company's lead drug candidate, Zitrin, failed to gain FDA approval. Despite a positive clinical trend and what many experts at the time considered meaningful therapeutic activity, the trial had not reached statistical significance of its primary endpoint. Now, in the dark days of the financial crisis, Pharmacyclics stock traded close to $1 per share, with the Nasdaq threatening to delist the company. Desperate, and with few other options, Pharmacyclics doubled down on Imbruvica, a BTK inhibitor that had shown 2 partial responses in chronic lymphocytic leukemia. The move represented a dramatic departure from its previous lines of research and was considered by many a long shot. The bet, however, would pay off. From the depths of crisis, Pharmacyclics would recover from the brink of delisting to a stock price of just under $15 in 2011, when Johnson & Johnson agreed to partner with Pharmacyclics on Imbruvica in a deal valued at $975 million. The drug went on to become one of the most promising new treatments for chronic lymphocytic leukemia, with Pharmacyclics stock hitting $261 in 2015 after AbbVie purchased the company for $21 billion. The story of Pharmacyclics, recounted in For Blood and Money, Billionaires, Biotech, and the Quest for a Blockbuster Drug, is a prototypical biotech investment story. Biotechs face the constant specter of a failed trial, the despair of a struggling research agenda, and doubts that can send share prices spiraling to the verge of delisting. And they hope for and often achieve the clinical breakthroughs pursued by big pharma and headline acquisitions that ultimately lead to outsized returns. Biotechs are perhaps the most promising and most heartbreaking companies in the small cap universe. They enter public equity markets for the purest of reasons: to raise capital at the scale necessary to fund the enormous expenses required to deliver life-changing drugs. When they succeed, they can achieve huge valuations in a short period of time, but they fail at a rate that's much higher than in other industries. In the last 30 years, of the just over 1,000 biotechs that have reached at least $200 million of market cap, a whopping 67% lost money. Of these, roughly 50% were acquired at negative total returns, 10% delisted, and the remaining 40% are still public, with a significant proportion trading below their cash balance, representing zombie biotechs, failed programs where cash remains stranded instead of being returned to shareholders. Of the 33% that were successful, 55% were acquired, and the remaining 45% are still public. In this white paper, we chart a path for how to navigate the sector. We cover the strangeness of the sector, the recent tribulations that have led to massive underperformance of the broad market, the important role played by specialist biotech funds, the factors that drive performance, how to manage risk, and ultimately, a strategy for how to invest quantitatively in the biotech sector. This is the culmination of over a year of work. We've built our own database of biotech specialist holdings and company insider disclosures. we've studied SEC filings, acquisitions, and company-level financials. We've created a point-in-time dataset of more than 130,000 clinical trials with metadata allowing us to quantitatively compare individual trials and company-level research programs. And we've built signals based on these datasets that help point the way to a strategy for investing in the sector. The biotech sector is difficult terrain to traverse, but consensus pessimism is what creates the ideal conditions to invest. The right data gives us the coordinates we need to cross the wasteland. With a disciplined, long-short strategy, we believe we can capitalize on the conjunction of change and science that defines biotech investing. Chapter 1: The Wasteland. Biotech is the cruelest sector. April is the cruelest month, breeding lilacs out of the dead land. T.S. Eliot, The Wasteland. Biotech stocks lose more often than any others. The median biotech company has delivered an annualized return of negative 15% in contrast to the median U.S. company's annualized 1% return. Since 1996, 67% of U.S. biotechs have had negative cumulative returns versus 48% for all other U.S. companies. Figure 1 demonstrates the relative underperformance of U.S. biotech compared to the broader U.S. market by comparing the annualized company lifetime return distribution from 1997 to 2025. The high failure rate is a feature of biotech's unique business model. Most biotech companies are essentially science projects that investors fund in hopes of discovering a revenue-producing drug. The sector, therefore, is dominated by companies with no revenue that raise money to fund research. Of companies labeled as biotech by S&P, 69% have no revenue, representing a full 57% of pre-revenue companies in the S&P Total Market Index. Companies without revenue and companies without profit are hard to value. It may seem easier to look away. But branches grow out of the stony rubbish, as Eliot says, and investors ignore the sector at their own peril. Biotech has historically delivered returns. For the 20 years before 2020, the S&P Biotech Index returned 9.3% annually versus 6.1% for the S&P 500 and 7.6% for the Russell 2000. Compensating for the high failure rate and many losing stocks are a few acorns that grow into mighty oaks, big winners that compensate for the morass of mediocre or horrible outcomes. Biotech is diversifying. Its very strangeness means biotech returns are far less correlated to the market than any other sector. Its average correlation to major industries is demonstrated in Figure 2. The correlation of biotechnology with other sectors is a mere 0.32. And biotech companies are numerous, especially outside the large cap segment. While they represent a small part of the S&P 500, they are a substantial part of the Russell 2000 and make up over 20% of the smallest companies. This is demonstrated in Figure 3. An industry that historically delivers returns, has low correlation to other investments, and represents a substantial portion of investments should not be ignored. And for quantitative investors, biotech has two very attractive attributes that make it especially useful for constructing portfolios. First, it has the most companies with which to build portfolios, more than any other sector. It makes up the largest share of the S&P Total Market Index, accounting for 400 companies, which amounts to roughly 11%. The next largest sector, banks, has only 300 companies or 8%, followed by software at 5%. Second, because major biotech outcomes result from scientific breakthroughs and acquisitions from big pharma, rather than the more quotidian business cycles that drive other sectors, the internal correlation of stocks within the sector to one another is much lower than in other industries. Figure 4 demonstrates the correlation of stocks within each sector. Biotech has the second lowest correlation at 0.25, bested only by consumer staples at 0.23. Low internal correlations means the diversification can provide more risk reduction than in other industries. though risk models need to be trained for biotech-specific data to capture this internal variation. As quantitative investors, industries with many names, low correlations to other industries, and low internal correlations are particularly attractive. Quantitative approaches work best when they can benefit from diversification. Industries where there is ample opportunity to profit from shorts also help to diversify and isolate profitable factors. We find ourselves drawn to the opportunities in biotech, but deeply aware of its dangers. After all, can a quantitative approach work in a sector with idiosyncratic successes that are not reflected in the financials until years after the value is known? We spent the past year exploring this question and believe we found a reliable, quantitative guide to investing in the sector. Chapter 2, Inferno: How Experts Can Guide Us. As Dante wandered in confusion until Virgil appeared to lead him, so too do most investors enter biotech in a kind of darkness, surrounded by unfamiliar science, opaque data, and no revenues to anchor valuation. In the introduction, we told the story of pharmacyclics. What we did not emphasize was the role of biotech specialist funds as its guides. In 2009, when pharmacyclics was $1.28 per share, with only early BTK inhibitor data, specialists such as OrbiMed, Quoque Capital, and later Baker Brothers recognized its potential and began buying. Within a year, at least 3 expert groups had invested. And a few years later, the company was acquired for $261 per share, a classic example of how great science is often identified first and rewarded most by specialist investors who quickly cluster to great ideas. Their collective judgment shows up clearly in our data. When we sort biotechs by how heavily they're owned by biotech specialist funds, from the least owned, quintile 1, to the most owned, quintile 5, a striking pattern emerges. Figure 5 demonstrates biotech company returns by biotech specialist fund concentration quintile. Notably, the difference in excess annualized return between the 5th quintile, which is most owned by specialists, and the 1st quintile, which is the least owned, is a staggering 22%. In general, the higher the concentration of biotech specialist funds, the better the stock performs. Conversely, if no biotech specialist funds own a stock, generally true of quintile 1, returns have been very poor. Because biotech specialist funds typically hold positions for nearly 2 years, and because the strongest signals come when multiple specialists own the same stock, their activity shows up consistently on 13F filings. As a result, even with a 2-month reporting lag, the 13F data remains both robust and highly informative. One interesting twist to our findings on specialist ownership is that 72% of specialist fund exposure is in large stocks. This is likely because multi-billion-dollar funds cannot just invest in small and medium stocks. But specialists are best at identifying return opportunities in small stocks. In the smallest third of biotech stocks, the stocks with the highest concentration of specialist ownership have nearly 30% returns in our historic data versus near zero returns for stocks with no specialist concentration. The implication is that smaller funds have a structural advantage if they can focus on smaller opportunities. But biotech specialist funds are not the only specialists we should pay attention to. There are 2 other sets of investors who also provide expertise: company insiders and short sellers. Company insiders are best positioned to understand the prospects of a company. There is a rich academic literature that shows that company insider transactions contain useful information about stock returns. This is especially true if the insider transactions are filtered through high information trades such as buys versus sells, reversals of previous directions, transaction clustering, and purchases by knowledgeable parties such as CFOs. It turns out that insider transactions convey information in biotech as well. Figure 6 shows how the strength of insider trade signals spread returns. Quintile 1 contains the companies where the insider trades are most bearish, and quintile 5 contains the companies where the trades are most bullish. There is a general increase in excess annualized return between quintiles 1 and 4 before tapering off a bit in quintile 5. Short sellers, who tend to be very active in this sector, provide another excellent source of specialist signals in biotech. In Figure 7, we show how our short interest metric spreads biotech returns. In this case, quintile 1 represents the most shorted companies, and quintile 5 represents the least shorted companies. The fifth quintile outperforms the first quintile by 35% annually. It turns out that short sellers are good at identifying potential losers and avoiding winners. This data is more broadly available for all stocks than insider trading data and is more immediately available than specialist data. In a sector where many companies fail, short sellers are guides that prove to be equally valuable to biotech specialist funds as company insiders. Biotech is a challenging industry, but expertise provides a path. Specialist biotech funds, insiders, and short sellers each illuminate part of the terrain. In Dante's words, after guidance through the underworld, then we come forth to see again the stars. Expertise does not guarantee victory, but it brings investors out of the darkness and closer to the truth. Chapter 3. Rerum Natura. Clinical trials as building blocks. Thus, by unseen decrees of smallest bodies, the mighty world is built. Lucretius, De Rerum Natura. In most industries, the smallest bodies in question are financial statements. In biotech, they're clinical trials. Revenues and profits, anchors of traditional analysis, are often absent. What matters instead is the probability that a company's asset will succeed in the clinic. Each trial readout is a binary moment where a stock can double or collapse overnight. Any serious attempt to model the biotech universe must therefore begin with clinical trials. Fortunately, clinical trials generate data as structured and information-rich as financials, standardized disclosures, required public filings, and oversight by the FDA. But the data is scattered, incomplete, and not designed for investors. ClinicalTrials.gov and the WHO's ICTRP provide raw inputs, but neither gives a clean longitudinal view of what truly matters, how a company's research program evolves over time. That evolution is messy. Drug candidates change names, partnerships form and dissolve, companies merge, spin out assets, and license or buy pipelines. Trial registries capture these events only in fragments. In Lucretius terms, the atoms move forever downward through the void, yet by a random swerve they meet and join. To understand biotech, one must trace those swerves and reconstruct the true lineage of every research program. So we built that map. Over more than a year, we created a point-in-time dataset covering over 130,000 clinical trials, drawing from registries, SEC filings, company documents, and government sources. This allows us to see at any historical moment exactly which trials are attributable to which company and how those portfolios changed. We then standardize the metadata into a hierarchical structure that lets us quantitatively compare trials to one another, backtest hypotheses with historically accurate data, and measure the impact of trial activity long after completion. From this foundation comes a deeper insight. Clinical trials let us classify companies. At each point in time, we can define a company by the attributes of its trials and by how similar those trials are to every other trial in our universe. This in turn lets us observe which clusters of biotech tend to move together. Companies focused on similar diseases, firms at similar clinical stages, or groups pursuing parallel therapeutic modalities. Rather than guessing which categories matter, we can measure them directly by calculating how similar each company is to every other one based on the compilation of its clinical trials. We create a peer-based similarity score. This allows us to compare a company to a weighted average of its closest scientific peers, an essential step in understanding momentum, valuation, and the risk inside biotech's unusually heterogeneous ecosystem. With these peer groups defined, we can begin to test whether a company's fate is influenced by the performance of companies most similar to it. One natural question is momentum. Do stocks with strong performing scientific peers tend to outperform as well? To answer that, we sort companies into quintiles based on the trailing returns of their closest peers. Quintile 1 contains companies whose peers have weak recent returns. Quintile 5 contains companies whose peers have been strong. The results, shown in Figure 8, demonstrate that a company's momentum follows that of its closest peers. Simply observing how peer companies have performed can turn out to be predictive of returns. For the quant, it should not be surprising. Momentum is a tried and true factor in investing and should spread returns. But it turns out that in biotech, momentum only works when we first define the peer universe for each company. To see how important defining the peer universe is, Figure 9 shows how the traditional momentum metric, which uses only trailing returns of the stock itself, spread returns. In short, the traditional momentum metric does not work at all. The worst performing stocks, which are the lowest quintiles, have the best returns, and the best performing stocks, the highest quintiles, have the lowest returns. Biotech behaves differently, and we need different metrics than in other industries. Another way we can use peer similarity is to measure if a biotech stock is cheap or expensive relative to its peers and determine if that helps predict returns. As it happens, it does. Figure 10 shows the returns of biotech stocks that are expensive relative to their peers versus cheap relative to their peers. The stocks that are cheap relative to their peers tend to outperform. Defining peer groups is also useful in risk management. To the extent that different categories of biotech move together or differently, we'd like to take this into consideration when building our portfolios. Clinical trial data allows us to build these risk categories to use in our portfolio optimization. The natural impulse in biotech is to treat clinical trials as riddles to be solved. To predict the result, win the stock. But quantitative investors approach them differently. Trials are not oracles, they're coordinates. They let us anchor each company within a broader constellation of its peers, turning uncertainty into structure, chaos into pattern. Clinical trials are not prophecy, but they do yield perspective. As Lucretius puts it, thus, little by little, time brings in view each individual thing, and then reason raises it into regions of delight. Chapter 4: The Golden Tree of Life: Rebuilding Factor Models in Biotech. I have studied now philosophy, and here I am, poor fool, no wiser than before. Goethe, Faust. Across most industries, quantitative investors rely on three durable factors: quality, value, and momentum. High-quality firms tend to outperform, cheap firms tend to outperform, and returns tend to trend. Importantly, these factors are largely independent. Each adds information even after accounting for the others. A stock's cheapness matters even when comparing companies of similar quality and momentum. But what happens when the traditional definitions of these factors simply do not apply? In biotech, the usual anchors dissolve. Quality is typically measured using gross profits. Value is usually measured using profits relative to enterprise value. Both require profits. But biotech companies, of course, have none. To build factor models that work in biotech, we need biotech-specific definitions. Fortunately, one of the pillars, momentum, survives. Traditional momentum does not work here. But with a modest reengineering, we showed earlier that similarity momentum does. Value is the next challenge. Here, the traditional momentum metric fails even more spectacularly. Figure 11 shows what happens when we naively apply the standard value factor to biotech. Quintile 1 contains the most expensive stocks and should do the worst. Quintile 5 contains the cheapest stocks and should do the best. But completely the opposite occurs. The most expensive stocks do the best, and it is hard to argue that there is a pattern in this data. Faust tells Wagner, "All theory, dear friend, is gray, but the golden tree of life springs evergreen." Nowhere is this clearer than in biotech, where the elegant theoretical framework of traditional value collapses on contact with an industry that has no profits. The obvious problem is that we are using profit as an anchor for value. We need a better measure of value. In biotech, potential value should have some relationship to the amount a biotech is investing in its clinical trials or research. Rather than focusing on negative profits, we could instead measure total spending and use that as an anchor for value. This simple change makes a difference. Figure 12 demonstrates this much improved value metric. The difference in excess annualized return between the first quintile, companies that invest little in clinical trials and research, and the fifth quintile, companies that invest the most, is nearly 25%. We now have both a measure of value and a measure of momentum. What remains is a measure of quality. And here we have a strong candidate, specialists. Specialist consensus, integrating biotech specialist funds, insiders, and short sellers, is nothing if not a verdict on company quality. And it turns out that it is not just a proxy for value. We can verify this by observing that value and quality metrics spread returns independently. If we divide companies into low, medium, and high specialist concentrations, the modified value metric still spreads returns as demonstrated in Figure 13. The best performing stocks are those that are favored by specialists and are cheap, while the worst performing stocks are the ones that are spurned by specialists and are expensive. These are useful metrics. Now we have value, quality, and momentum metrics for biotech. When we combine all of these factors together and use them to estimate forward returns based on their trailing contributions, we find that we now have a factor model which does an excellent job of spreading returns as demonstrated in Figure 14. The blended factor model outperforms any single factor, and most importantly, uncovers opportunities to not only go long the strong, but to go short the weak. It demonstrates a negative 17% excess annualized return for the first quintile of companies and a positive 21% excess annualized return for the fifth quintile of companies. With this foundation in place, we can now ask the practical question: how do we build a portfolio that harnesses these insights in a disciplined, optimized way? Chapter 5, Back to Ithaca, Building the Quantitative Model. To strive, to seek, to find, and not to yield. Tennyson, Ulysses. More than almost any other sector, biotech investing is about managing risk. The high failure rate of companies means that there will be many losers. The implication of a high failure rate is that portfolio concentration is dangerous. Diversification is essential. The other implication is that the path to success is likely to be volatile. To us, shorting is perhaps the most important and least explored investment approach in biotech. Shorting is important because it allows us to take profit from losers and reduce the volatility of typical returns in biotech. To illustrate the importance of shorting, we first look at the performance of a long-only strategy. We earlier outlined the excellent performance of biotech specialist funds. Why not just invest in biotech stocks most widely held by biotech specialist funds? When we look at the time series of returns for the top quintile of biotech concentration versus XBI, the ETF which tracks the biotech universe, we can see something remarkable. In Figure 15, we see that specialist returns are 82% correlated with the benchmark ETF. There is a clear return benefit, but very little risk reduction following the specialists. The max drawdown for a strategy that follows specialists is 61% versus 57% for the XBI, and both have the same average standard deviation of annual returns at a whopping 29%. This type of volatility will leave an investor weak by time and fate, as Tennyson says. Furthermore, the specialist strategy seems to earn most of its performance in calm markets, not volatile markets. If we break down the return into periods of low, medium, and high volatility, we can see the average monthly return for a strategy that follows specialists is highest in low volatility environments. This is demonstrated in Figure 16. In fact, the strategy takes almost all of its performance versus the XBI in these environments, which represent just a third of all time periods. A specialist strategy is very good at helping to identify where returns come from, but it has little to say about risk. In an industry with high company failure rates and high volatility, risk is certainly as important as return. It is to that challenge that we can now turn. Shorting is a dangerous and difficult strategy. It is an approach that requires diversification and discipline to execute well. This is where a quantitative approach has advantages over a purely fundamental one. Factors are how we transform fundamental insights into data that can be fed into quantitative models. Humans are good at creative processes that identifies return factors. Computer programs are far better at executing the statistical code that combines expected returns, correlations, trading costs, shorting costs, and other constraints. To build a portfolio that takes full advantage of a two-sided return distribution with both winners and losers, we need more than an idea of expected return. We need to build a risk model. To do that, we forecast not just factor returns, but factor volatility and factor correlations. The details are technical, but they can be thought of as predictions based on a weighted average of historical observations. We need the historical volatilities and correlations because the optimizer will try to maximize expected returns subject to volatility constraints, and it will calculate the volatility based on the predicted factor volatilities and correlations. The optimizer will also take into account other constraints that we specify. The most important ones in this case are trade costs, shorting costs, and short availability. Trade costs are the direct cost of the trade, but also the market impact cost. Smaller stocks with low liquidity will be more expensive to trade. Shorting costs are the costs to borrow the stock, and short availability makes sure that the stock is even available. At this point, the analysis becomes a conversation with our optimizer, where we do our best to specify the constraints in a realistic manner and then see what the optimizer produces. In Figure 17, we specify a set of constraints and create a portfolio each week from 2015 to 2025. The backtest return series, shown in Figure 18, is net of all costs, including trading, execution, and short borrow costs. In summary, both the annual return and max drawdown of our backtests are superior to those of both the XBI and the S&P 500 over the same time period. These results are encouraging. The model takes significant short positions relative to long positions and achieves its target volatility of 20%. The dramatic reduction in volatility is most notable by looking at the time series of returns versus the XBI denoted in Figure 19. An optimized portfolio that takes advantage of shorting in biotech has a much smoother return path than a pure factor model that goes long the top quintile of specialists. And importantly, this backtest is realistic. It takes into account trade sizes, trade costs, and availability of shorting. Biotech is a risky and complex industry, but as Tennyson says, though much is taken, much abides. The sector follows investing logic to some degree. Cheap companies do well, expensive companies do poorly. Company returns cluster and move together. Higher quality companies outperform. But in a sector with so many losers, a long-only strategy has trouble capitalizing on this dynamic. A long-short strategy can do this well, but it requires discipline and diversification, features that a quantitative approach does particularly well. Chapter 6, Renaissance. Why Biotech is primed for a second spring. Since December 2019, before the start of COVID, the S&P Biotech Index has returned just 4.5% per year, while the S&P 500 has returned 15.1%. The S&P Biotech Index is still down 21% from its February 2021 peak, despite retracing 36% in 2025. Over the same time period, the S&P 500 has risen 88%. By any measure, biotech remains in a drawdown. Rising interest rates have choked off speculative investment. Price pressure from the government's new powers under the Inflation Reduction Act have decreased terminal values, and a few high-profile trial failures like Shade Therapeutics and Fibrogen have increased perceptions of fundamental risk. But in our view, the opportunities arise when investors withdraw capital from small, illiquid markets, when pessimism and forced selling drive a collapse in share price, even as fundamentals and prospects of recovery seem high. In these scenarios, small changes in investor perception can drive massive swings in share price, particularly among the most illiquid small caps. When we put the drawdown of the biotech market relative to the S&P 500 in context with historic periods of comparable relative underperformance, we can see how biotech performed in the subsequent 3 years. On average, biotech saw a more than 60% return over the subsequent 2 years, a return comparable to the results we saw in our major study, Crisis Investing. This is demonstrated in Figure 20. Biotech has been through harsh winters before, and there seem to be reasons to think that spring is coming for the sector. First, there's an estimated $200 billion in annual drug revenues at risk by 2030 due to an expiration of patents on blockbuster drugs, the largest patent cliff facing the pharmaceutical industry since the early 2010s. As patents expire, the market share of a drug can plummet by 80% or more within the first year of generic biosimilar entry. This puts pressure on large pharmaceutical companies to acquire new revenue streams to replace expiring assets. Second, we are living through a period of tremendous pharmaceutical innovation. Think GLP-1 agonists for obesity, next-gen antibody-drug conjugates, radioligand therapies, and advances in cell and gene therapy. Indeed, 2024 marked the 5th year out of the prior 7, with new drug approvals reaching or exceeding 50 and besting the 10-year trailing average of 46.5. Of the 50 drugs approved in 2024, 72% were developed by small and mid-sized companies. This momentum has continued. Despite a tumultuous period at the FDA, 2025 has yielded an additional 46 approvals, further cementing this high-output era for the industry. Third, the widespread integration of artificial intelligence into R&D offers a long-term pathway to improve productivity. AI-powered platforms for drug discovery and tools for optimizing clinical trial design and patient recruitment have the potential to reduce developmental timelines, ultimately increasing the probability of success. According to a study by McKinsey & Co., an achievable average reduction of 6 to 12 months in drug development timelines across the portfolio will result in a net present value increase of $200 to $400 million. Earlier this year, sentiment regarding biotech could hardly have been bleaker. Latham and Watkins noted that the 2024 biotech IPO cohort was down 50% from deal price. Tim Opler of Stifel described a complete withdrawal of capital by non-specialists. The generalists are gone from our market. But it is out of such consensus pessimism that great investment opportunities are born. The challenge is how to follow the fundamentals with discipline amid speculative despair, to chart the course with data as our coordinates and reason as our compass. We believe the strategy outlined in this white paper can position us to benefit from biotech's rebirth. Thank you for listening to this recording of Biotech Investing, Investment Approaches That Work in a Challenging Industry, a white paper by Verdad Advisors in Boston, Massachusetts. If you have any additional questions or comments, we'd appreciate hearing from you. Please reach out to us by email at research@verdadcap.com. Thank you for listening.
If you enjoy the show, be sure to leave us a rating and a review on your favorite platform. You can read investment research like you heard today by subscribing to the Idea Farm's free weekly e-newsletter at theideafarm.com. Thanks for listening, friends, and good investing.